I'm very pleased to introduce Elizabeth Warren. We're very excited she's here today. I know a lot of you are looking forward to this. We actually met in some meetings around these topics. I admired her from afar, and then we began talking, and I learned that in terms of our course title, she's perfect for this because she said, I'm from a mixed marriage in Oklahoma, Baptist and Methodist. And she's a Methodist Sunday school teacher at one point, and I learned a Sojourner subscriber, so I was very proud of that. But she really has put the values question in the heart of this economic debate, and we're glad for that. She is an attorney, a professor of law. She's the Leo Gottlieb Professor of Law at Harvard Law School, where she teaches law, contract law, bankruptcy, and commercial law. And in the wake, as you know, of the 2008-9 financial crisis, she became the chair of the Congressional Oversight Panel, created to investigate the U.S. banking bailout, of course, TARP. And she became a tireless advocate for the creation of a new Consumer Financial Protection Bureau, something that many thought was needed, and really she was the person who put this idea in the center of the conversation. And it was passed as part of the Financial Reform Bill that you've read as preparation here. And on September 17th, she was named to the delight of many of us to be the special advisor, title is Special Advisor for the Consumer Financial Protection Bureau by President Obama, to oversee the really startup development of this new Consumer Financial Protection Bureau. It's not often that you get to propose an idea, then get to actually do it. So it's a blessing that she put this idea out there, and now that she's doing it. And she, for many of us, is a real bright and hopeful spot in our situation now, which needs, I would say, some bright and hopeful spots. So I admire Elizabeth a great deal. We've become friends. And when I thought about this course, I thought, who better to talk to us about faith, social justice, public life in relationship to this economic crisis, but our friend Elizabeth Warren. So Elizabeth, thank you for coming. She was busy before I asked her to do this, and she said yes. Then she got even busier with a new job, and she still came, and I really appreciate that. Thank you very much.
Thank you. All right. I prepped before I came in here. So I'm delighted to be here today. I am partly very pleased to be here, to be in the company of Jim Wallis, who means a lot to me and means a lot to America and to the moral questions that we should be talking about. And I am especially glad to be here. I'm also especially glad to be here because I miss being in the classroom. I'm a teacher. You know how some people know from the time they're very little what they want to do. My dollies suffered because I insisted on running classes from the time I was about 4 years old. But I hope not to make it painful. But I'm glad to be here and back in class. So what I want to talk about today is to start with the notion, actually where Jim starts, and that is to talk about the moral crisis underlying the recent financial crisis. Jim is right in calling this a transformational moment that will require, at least in part, transformation of our financial system to reflect our sense of justice and common humanity. Let's talk for just a minute about the Dodd-Frank Act. You may have read about it. This is the financial reform that was passed and signed into law by President Obama on July 21st of this year. Now, it was enthusiastically supported by many people of faith, and it gives me a very hopeful moment, not only for what it could do for the economic recovery of middle-class America, but what it could also mean for our moral recovery, as Jim puts it. A central piece of the financial reform bill is the Consumer Financial Protection Bureau, I still call it an agency. Although I checked, and there's no statutory difference between those. It just got a different name somewhere along the line. So the basic notion of this consumer agency is that it has a lot of tools on the table to deal with consumer financial products. And when you think about what are these consumer financial products, we kind of use these awkward terms because we're trying to encompass a lot of things. So it's about credit cards and mortgages, about what are called closed-end loans, which means for a term, like car loans and student loans. It's about payments, remittances that are sent to other countries, stored value cards, check overdraft, the ways in which people borrow money, and some of the ways in which they simply transact, like stored value cards. Also about the credit reporting system is part of that, and the debt collection system. So it's all now, for the first time ever, under one encompassing umbrella here. And the idea behind this agency is to be able, in effect, to encourage honest business and to offer consumers some basic human protections, like the ability to understand and compare the costs of financial products. At its heart, the ideas behind it are pretty simple, but they are deeply moral questions. So I want to start with this acknowledgement about the consumer agency. I think it is a powerful step in the right direction for moral recovery, but it is important to acknowledge that this transformational moment also depends upon individuals who exercise their responsibility toward one another and acting in a way that reaffirms our common humanity. Borrowers have a responsibility to make better choices. When costs are clear, some must dial back the risks, some must purchase less, some must decide to use a different payment system. People have a responsibility to exercise self-discipline once the costs are made clear and once the financial system adequately serves them. So it's an important part of understanding this agency is that not all the work is done at the government level, it's done by individuals. But it's also done at the lender level. Gandhi once said that economic exploitation takes its toll on both master and victim because, as he put it, no one can be human at the expense of another. With this in mind, we need to observe the behavior of lenders. Lenders have a responsibility to engage in open, good faith competition, not just because the new consumer agency will reward them for taking such action, but because it is the right thing to do. So this is going to be an agency that's going to be partly about government rules and regulations, about putting a cop on the beat to police the marketplace, but it's also an agency that's about recognizing that much of the activity comes from individuals and how they behave, and from corporations and how they behave. So we really have a three-part conversation going on here. Now, while the Consumer Financial Protection Bureau makes sense at an economic level, and I'm glad to talk about this, a lot about it, I use any opportunity I get, I want to take this particular chance to tell you about why the consumer agency seems so important to me at a personal level. I grew up in a family without much money. My father held a series of jobs. His last one was mowing lawns and cleaning swimming pools for an apartment house. My mother wanted to stay home with the kids, but she ended up taking a job answering the phones at Sears because that was the way and that's what it took to be able to put groceries on the table. When I was growing up, we always had a doctor bill, and it was clear that my parents worried a lot about money. There was no money to send any of us to college. I was lucky enough to get out there and get a scholarship, and that's how I made it. But my parents worried a lot, and they worried about money. But I grew up in a very different time from the time now. I grew up at a time when there were strong usury laws, and that meant that my family, for all of our worries and for how close we lived to the edge, never actually fell off. We never ended up in a deep hole that we couldn't get out of. We were active in our church, as Jim said, First Methodist Church of Norman, Oklahoma. We knew the loving embrace of our family and of a church family. And we knew the protection of laws that kept powerful businesses from crushing little families like ours. I was raised to believe in simple precepts like Matthew 25, which you'll have to forgive me, but I still do it in King James because that's the way I memorized it. Inasmuch as ye hath done it to the least of thy brethren, ye hath done it unto me. It was a guiding principle for my life. We didn't have much, but we always knew about both taking but also giving, that it was an important part of who we were and the community we grew up in. I was also raised to believe in Isaiah 65, which speaks of a world in which those who build houses shall inhabit them, those who plant vineyards shall eat the fruit of them, a world in which people, as you may recall, shall not labor in vain. I think these precepts are important, and let me see if I can tie them in to what happens later on in our economic lives and how we, the role that the consumer agency will play. When I first began as a young law professor to pick my field of study, I was very interested in commercial law and economics generally, and I decided to study families that filed for bankruptcy. This became one of the first things I looked at. It was partly because the bankruptcy laws had been changed shortly before I became a teacher. And so I was teaching out of a brand new law that no one knew a whole lot about at that point. And it was partly because it always interested me. I didn't think I ever knew anyone who'd gone bankrupt. And I knew that my family had had a lot of financial trouble, but we'd always stayed on the other side of that line. And so I went into the first study of bankruptcy really expecting to expose the families who are filing for bankruptcy. I really saw it as these are probably people who take advantage of an overly generous law in that great continuum of laws of forgiveness. America's laws on bankruptcy, particularly at this time, which is the early 1980s, were very much on the generous end of forgiveness. And so I figured, and bankruptcy rates were rising, I figured that more and more people had figured out how to behave strategically, that they were willing to take advantage of generous laws, that they would run up bills that they didn't plan to pay, and then they would cancel their debts in bankruptcy. In a sense, my first academic study was a moral search. I was there on the side of what I believed was going to be the righteous, to expose those among us who were immoral. So I went out with two co-authors to study the families who were in bankruptcy. We pulled court records from different states around the country. We analyzed what was happening. And that's not what I found. Instead, what I found was something that offended my conscience much more deeply. I discovered a system in which flat wages and rising core expenses had stretched families to the breaking point. That families turned to credit largely to pay for medical bills, to pay for college, to make it from now to the end of the month. And that when they did, they encountered a world that was full of tricks and traps. Yeah, there were some people, certainly people who ended up in bankruptcy, who had charged too much on their credit cards, who tried to buy things they couldn't afford. But there was also a market laid out that was deliberately designed to deceive them. Competition was not about who makes the best product. Competition was about who could hide the most devious tricks back in the fine print. I saw lenders, both banks and direct investors, the ones who set up shop on the internet or who advertised heavily on the radio, encourage consumers to buy homes and to take on credit that they couldn't afford. They often misstated the price or concealed the risks, knowing that the families who came in were headed for a world of trouble. Over time, I watched that market get worse and worse. I repeated the studies from the early 80s, again in the early 90s, again in the early 2000s, again in the mid-2000s. And each time, I saw a market that was ever more devious and ever more aggressive in selling to people who would get hopelessly trapped, hopelessly ensnared in the products that were offered. I saw how, as Jim Wallis puts it, the myth of the sinless market put these families at risk, and how the consequence has been high debt levels, record foreclosures, and rising bankruptcy rates. I just saw yesterday that our bankruptcy rates have risen another 13% over where they were a year ago right now. Remember, already deep into the heart of the recession. We'll have this year, we're on target to have about 1.6 million families declare bankruptcy. That's going to be over 2 million adults, since a husband and wife declaring together just counts as one. And if we include the children, since families with children are disproportionately more likely to end up in bankruptcy, we're talking about over 3 million Americans in a single year in bankruptcy. So we're talking about a lot of hurt out there. What was happening in the consumer credit markets was literally unprecedented. Now, I should point out, many of you will know this, but let me set the stage here. America has always had usury laws. We had a long history of prohibitions on the amount of interest that any lender could charge, and it varied from state to state, both the amount and exactly who was protected. It always has protected individuals. Sometimes it protects small businesses. Sometimes it protects all businesses, little bit at the margin on the question of business lending. But usury was not certainly an American invention. The biblical scholars among you will pick up on it, but it's also in the Quran, in the Torah. Plato, Aristotle, Cicero, Muhammad, Moses, Aquinas, Buddha condemned usury. Usury was banned by the Code of Hammurabi in the 14th century. In fact, if you think of it this way, usury laws are our first real consumer protection laws. The first widely acknowledged, we have some protection for regular families who are getting about their business, and that is that you can't lend to them above a certain ceiling. So that's period one. Code of Hammurabi, we'll start with them, in 14th century BC. All the way through biblical times, it goes through Europe, goes through Asia. We reach the colonies in the United States. All 50 states have usury laws, and that time period ends basically in 1980. So that's period one in consumer credit. It kept interest rates relatively in check, and it kept a business model relatively. Here's how the business model worked basically on credit. You can only charge so much, so there's not much point in trying to fool around about what your price is. There was not a lot of incentive to pretend to sell at one price and then you're in fact going to charge something else, because you just bump into the usury ceiling. So instead, the model was around, do I actually think you're likely to repay this money? and setting a price that makes sure you'll have a little protection against those who don't pay, a little protection against inflation, and a little profit. And that's basically how lending was done to families from about the 14th century BC until 1980. In 1980, it actually happens in a two-step process. We can talk about the law of it right at the end of 1979 and then again in 1980 and 81. We effectively get rid of the usury laws in the United States. They were not officially repealed, but they effectively disappeared. If you want to hear the legal story, I can tell you the legal story. But the version, what happens is it starts to create a Wild West for the lenders. So here's what happens. Usury laws, as I say, they effectively get repealed. Not much happens for about a year or two. It's a period, early 1980s, of very high inflation, and the usury laws, because they were not written in a sophisticated manner to move with inflation, there was a lot of lending that was bumping right up against the usury cap, even just for ordinary families and ordinary circumstances. So bang, away goes the usury cap. Interest rates on borrowing go up, but they start to come back as inflation is under better control. And the CEO of Citibank figures out that if he will locate his bank in a state that has a very high or no usury cap, that his company can mail credit card offers all around the United States, and the interest rate that will control will be the interest rate for the home state, the place from which the mailing is made. So he flies out to South Dakota, and he says to the governor of South Dakota, if you will raise your usury cap, then we will locate in South Dakota and bring along jobs and revenue. And it took the South Dakota legislature just a few days to say yes, under the governor's direction. And Citi set up shop in South Dakota. And if any of you have Citi cards and have ever wondered why they are mailed out of South Dakota, I'm telling you the story. Now, it didn't take other states very long to figure that out. And so Delaware immediately said, oh, if South Dakota can do it, so can we. Maryland said, we will do it too. And states like the state of Massachusetts, who said, no, we still have a usury cap. The problem was you could mail the credit offers from outside, and it meant you effectively had lost the capacity to protect your citizens, for example, on credit cards. So what this meant over time was that it created a kind of Wild West for the credit issuers. Now, their first cut could be just to raise interest rates, go up to 14%, 16%, 18% on credit cards. But pretty soon, customers started looking at the different card offers. There was so much money in the industry to be made by the difference between the wholesale cost of money and what they were lending it for on credit cards, that what happened was that the price starts coming a little bit down. People, this is how markets work. People say, wait a minute, why would I borrow from you at 17%? Somebody else just put a mailing in, sent me a mailing for 14%. You actually watch interest rates kind of trickle down just a little bit, not nearly as much as inflation had gone down, but you see them start to trickle down a little bit as we're getting into the late 1980s. But then the new idea is developed, and the new idea is, how about if we tell people that we'll lower the interest rate to 12, to 9, to 7.9, to 3.9? How about zero interest rate? And what we'll do is count on making it up in the back end. That is on fees and on surprises, on what's called repricing your interest rate. So we will decide after you've taken out the credit card and you're working with the card, we'll just raise you back up then to 14.9 or 24.9, or maybe it's 29.9. So the game became, in effect, pretend to sell at one price, knowing that what you're really doing is going to make all your revenues at a very different price. And that became the model in the consumer credit card world. And it became enormously profitable. It went from credit cards to other forms of lending. Payday lending grew up in this time period. We can talk about it if you want. And even by the time we hit the late 1990s and early 2000s, even the mortgage markets had looked over and said, gee, this had been a really pokey business. It was a small profit, but a very steady profit, doing mortgages for decades. All of a sudden, the notion was, make a lot more money selling mortgages. How do we do that? We pretend to sell them at very low prices. Maybe you heard about 228s, that is, you get one rate for the first 2 years and a staggeringly high rate for the remaining 28 years. But you get people in the door talking only about that first 2 years. Or there's an enormous fee to refinance after the first 2 years. That's usually part of it too. Anyway, the model shifted over time. Profits soared and families suffered, both financially and personally. Women, in particular, were faced with the difficult task of putting the pieces back together again when families were on the brink of financial collapse. This put an enormous strain on marriages, on other relationships, and too often led to situations of abuse. We all remember America's boiling point. The subprime mortgage meltdown happened because dangerous and complicated mortgage products injected so much risk into the system that ultimately they not only destabilized millions of families, those risks were aggregated and they brought down the entire economy. Those mortgages broke families one at a time. They eventually broke our entire financial system. It offends our conscience when the actions of a few individuals for their own profit hurt many. It is particularly offensive when those hurt are the least able to recover financially. And I think this goes to the first point I made about inasmuch as ye hath done it unto the least of thy brethren. So this is part of the reason I'm working in Washington today. A group of people, not big Wall Street players, not bankers, not lobbyists, fought to get a new consumer agency passed into law. I am very proud to say that I stood shoulder to shoulder with Jim Wallis and with many good people to push for this agency. If you want a modern day David and Goliath story, this is the story to look for. Small groups of grassroots organizations were in there pitching, the Greater Phoenix Housing Authority, folks all around the country who began to watch this and pay attention to this little consumer agency and said, this is one thing we want coming out of this financial crisis, a way to put more balance back into the economic system to protect families. It was also a place where Consumer Reports, Consumer Federation of America, AARP, the unions, the Leadership Conference on Civil Rights, and PIRG were very active. All these groups joined together, big and little, in order to push for this agency. Now, the odds, even with all these groups pushing, were ferociously against us. There was no real money on our side. The Chamber of Commerce alone was pouring millions into lobbying specifically against the agency. One big Wall Street lobbyist announced on the front pages of the New York Times in August of 2009 that Wall Street would kill the agency. That was his verb, would kill the agency. It would, before it was ever born. But in the end, we prevailed. This is a story in which David won. So, what can our new little agency do? Well, the new agency will provide a direct line of support to families. It can outlaw the tricks and traps that families face. It can mow down a lot of the fine print in credit products where those tricks and traps lurk so that people can read their agreements. It can promote competitive markets where customers can see the costs and the risks up front, and they can make straightforward apples-to-apples comparisons among products. Let me put that in the very specific. Think about the possibility of a 1 or 2 page credit card agreement. It makes clear what the fees are, if there are any, what the interest rate is, what the penalties are and what triggers them, and the purportedly free gifts. If you can do that in a straightforward way so that the costs are clear up front, so that the risks are clear up front, and so that it's possible to take 4 credit card agreements and say, that's the one, that's the cheapest, then markets start to work on behalf of consumers. They are more virtuous markets because they clearly identify what the product is, what it costs, and then let the consumer make an informed decision about it. More transparency is going to make it possible for customers to make good decisions to protect themselves. And for those of us who believe in markets, competitive markets should reduce the overall costs. By outlawing some of the tricks and traps that these families face and making markets more competitive, the consumer agency can help families become steadier economically. I think of this like a hole in the bottom of the boat for families right now. For some, the hole is little. For some, the hole is bigger. The money that they lose through credit, not through other expenses that they're doing, not the storms that hit them on medical problems or family breakups or unemployment. It's just a hole in the bottom of the boat. This agency won't fix everything that's wrong economically with middle-class America, but what it can do is repair this hole in the bottom of their economic boats. This transformation of our financial system ultimately, I believe, will make the whole economy more secure by encouraging honest and upfront competition, which prevents the sort of reckless behavior that led to the crisis in the first place. But I think it goes beyond that, and this is the reason I wanted to be here today. I believe that the new consumer agency will add greatly to our country's moral and spiritual security. It sends a signal to all that America is genuinely dedicated to the least of our brethren, and that it is not acceptable to pursue wealth at the personal expense of others. That's not how the American dream was meant to be pursued. So, I'm going to wrap this up so we can have a good conversation, but there are a couple of things I want to leave you with today. First, and perhaps most obviously, I want to reinforce that there are profound moral and religious dimensions of the financial crisis, and more broadly of the economic lives of American families. It is this dimension, this sense of right and wrong, that drove me to study the day-to-day economics of Americans in the first place. These values, solidarity with the least of these, respect for hard work, pursuit of justice, and individual responsibility for the well-being of all, are not new. Every religious and ethical tradition speaks to them. It's not merely suggested that we look out for our fellow human beings. In a moral world, it is required. It is our obligation. So that's my first point. My second is that I want to leave you with the thought that in order to take advantage of this transformational moment, we need to repair our financial system so that it reflects our shared moral values. Part of what makes America so great is its individualism and wealth have never been completely about money, obscuring all else. Americans are a fiercely idealistic and spiritual people. Spirituality and idealism are a sense of our own collective identity. The new consumer agency can help restore some of that balance by making markets more honest and by putting consumers on a level footing with those who want to sell them credit. So that's my second point. The third is that I want to make the point that the new consumer agency is not about punishing those who engage in business. It's about making business honest so that it works for everyone, so that no one labors in vain. I want to tell you a story about a meeting I had just very recently with the CEO of a major credit card issuer. You would all recognize the name immediately. And in this conversation, the person talked about building the credit card business and how this company had figured out that they thought they could better assess on the old model who would pay and who wouldn't pay. And that was going to be their comparative advantage. And by golly, they did a good job. And they really built a strong business model. And they got out there and did lots of fancy advertising like everyone else, but they thought that was their competitive advantage. So he described to me how they had a card that worked for the well-to-do. They knew how to make that one work. And they actually had a card that worked for people who were right at the economic margins. They had a pretty good card that worked. But their problem was, just for a lot of people right in the middle, they could never get a card that worked. Why could they not get a card that worked? This is the interesting point. He said, look, my view on the cards was we needed to make the cost pretty clear up front. And he said, I wanted to be a price smasher. That was my business model. That's how I built it at the top, and that's how I built it at the bottom. Everyone else was charging a margin like this, the difference between what you had to pay to borrow the money and what you were lending it out on your credit cards for. And he said, I could make a lot of money at this. I was willing to go for a lower profit, get a big volume, build up a big business, and do well. So that's what we want. That's how competitive markets are supposed to work, right? And here's what he said. He said, so I figured out that I could do a card with six percentage points, right? 6%. I could make this work. And other cards out there, much bigger margins, 14, 15 percentage point margins. And he said, so I figured out I could do this. But he said, what I did is I kept putting out a card that told what the price was, because the price was clear up front. He said, and I was always competing against somebody who claimed to be selling it for 0% interest, for 3% interest. And he said, I knew, because I knew their model, I knew their numbers, that what they were really doing was selling it for a much bigger margin, but nobody was going to buy my product as long as I was competing in a world where somebody else could purport to be selling it, in effect, for free. And so what this is really about, and this is the point I want to draw in, it's not an anti-business point, it's a pro-business point, but it's business at which everyone competes in an open and honest way. So there's balance between the customer and the business. They both see it. And the customer can say, if that's how much credit costs, then I don't want to buy it. Or I'm willing to pay that. And the businesses who compete with each other are competing in an open and transparent way. Everybody's making it clear what the prices are. So what we're really talking about here, if we get this right, is a morality that becomes self-reinforcing. It's good in the business world. It's good for consumers. Everyone has personal responsibility to exercise, but they can do it because there's transparency, there's honesty in this marketplace. So, the last thing I guess I'll say before I sit down is that I believe we need a moral compass in our personal lives. There are things I won't do. There are things I presume each of you in this room won't do. That's where our moral compass lies. But we also need a moral compass in our collective lives. It is our individual responsibility to work for laws and for rules that make sure that those who work hard and play by the rules have a chance to survive, that they aren't tricked out of their security, and that those who want to compete can do so in an honest and fair manner. I believe we owe this to ourselves, and I believe we owe it to each other. So I will quit there and join the discussion. Thank you, Jim.
You had mentioned that bankruptcy has risen another 13% in the last year. And I also read that a study that you published with David Himmelstein that was published in 2007 about the primary reason people file for bankruptcy is due to medical costs. And I was just wondering, since then, if you believe that that is still true, and if you could maybe elaborate on that. And then is this issue being addressed? Is it being addressed properly, or what needs to be done to address it in that way?
So let me see if I can give you a kind of overview of what happens. If we start, let's do this in a little long arc on the history. Let's start immediately post World War II in the United States. What you observe happening is that productivity in the United States, I'm not going to do it with the chalkboard, but productivity basically, we'll do it. It's more fun. Okay? So what we see is, let's start in about 1947. Productivity in the United States sort of does this. I mean, it kind of goes up and down, but it's basically moving up. Okay, that's our GDP. This is how much wealthier we are getting as a country. And what happens is the wages, because this is what you want to watch, of a fully employed male. So fully employed male's wages, some a little up, but you get the same pattern. Until we hit the early 1970s. And then what happens is that productivity continues to rise and actually rises at a steeper curve. And wages for a fully employed male start flattening out. And so you see this gap. In other words, collectively, we get richer, but the middle earner in the United States, and I just use it as the prototype, the fully employed male, adjusted for inflation, obviously all this is adjusted for inflation, just flat lines. Families, I'm going to tell you actually two of my books at the same time. This is you get such a bargain here, okay? Families respond, I'll give you one more color, by sending more people into the workforce. This is where the married couple is able to keep a little more growth going. So they get some upward trend by sending both mom and dad to the workforce. Of course, if you only have one parent in the household, or if you want to try to keep a parent at home, this is the world you live in. So this is the thrust for America. Now the consequence of this, at the same time, we could do a whole thing on what's happening to expenses, but inflation adjusted core expenses in the United States, and let me just give you what I think of as the core expenses: housing, healthcare costs, child care, transportation, and total taxes. It's 5 pieces. Those go up. What families do to adjust is they cut back on all the other expenses. All the ones I think of: food, clothing, appliances, furniture, they're cutting back. And the key to this, in watching this, what this means about the budget, is the budget starts to shift to be big fixed expenses, things you can't take a half an insurance policy, right? You can't, for health insurance, you can't sell off a bedroom, if you get into trouble. You can't say we're just going to cut back the way you can on food or you can on clothing. So families have cut back on all their flexible spending. Their core expenses, what it takes to make the monthly payment, continue to rise. And what happens in that time period, now we get here's the 1980s when this is happening, right? What we're doing it, so the 1980s. This is when the credit market effectively becomes deregulated. So families start turning to credit. And they turn to credit to, just like I said, they turn to credit to deal with medical problems. They turn to credit to buy their houses. They're taking out mortgages. Between the early 1970s and the time we hit the early 2000s, inflation adjusted, what a family is spending on mortgage is 100% more. Think about that. On what is effectively a flat wage for the fully employed male, affordable only if they've got 2 people in the workforce and can keep 2 people in the workforce all the way through, keep making those core expenses. So the reason I go into this is what that means is that by the time you get out here to the 2000s, is that you've got families, I'm just out in ink here, by the time you get out to the 2000s, you've got all these little individual boats, this is kind of how I think of it, that simply are far less secure economically. And then it's the big three. If they get hit by any combination of unemployment, healthcare expenses, unusual healthcare expenses, or a family breakup, they're gone. And that's what our data are all about. So the families who file for bankruptcy, actually, this has always been interesting because of the way the studies were done. The single most likely, this is true even back in the 90s, that would push you over into bankruptcy was a long period of unemployment. Healthcare, the other one, and family breakup, meaning principally divorce, but not always. It's also death in the family. It's couples who were living together and had children and split apart, which is sort of the equivalent of divorce. We have a little of all three going on there. Now, and by the way, for more than half of the families who filed for bankruptcy, they got hit by at least 2 out of 3. So it was some combination of those. Divorce and a medical problem, or a medical problem and unemployment. And the causation arrows ran every direction. There were people who they lost their jobs, and that meant they lost their health insurance, and then they got sick, and so an illness that would have only cost them this much now costs them this much. It went the other way. There were people who got sick and as a result lost their jobs and as a result lost their health insurance and ended up in bankruptcy. So bankruptcy was the place, it's like a funnel, where a whole lot of different problems fall into the same place. But it's really a dynamic to understand this. All by itself, a serious enough medical problem could put someone in bankruptcy even back here. You know, the really horrible medical problem, the prolonged with lots and lots of expenses. The difference was, as families became more economically vulnerable, it took less and less to pitch them over, to swamp the boat, if you stay with the same analogy. So, the difference between our two studies, I knew I would wrap this around to where you were, and that's on the question of health care and medical bankruptcies. We did 2 studies, one based on data drawn in 2001 and one based on data drawn in 2007. And basically what the data show, about half of all those in 2001 who filed for bankruptcy did so in the aftermath of a serious medical problem. Now they sometimes had other problems as well, unemployment or a divorce as well, but clearly had a medical problem in it. By the time we get to 2007, when we draw our second database, it's up at about 62%. So it is a growing problem in bankruptcy. Now, unemployment is now up. So which one is leading the pack? We don't have numbers for 2010. My view has always been they're both very, very serious problems economically. So I hope that's helpful.
Hi. With the recent midterm elections and the Republicans gaining a lot more seats in the House, and just with the fact that Republicans generally aren't as much for regulation, do you think that that will affect in any way this Consumer Protection Agency and the power of it to help out the economy?
So the answer is partly, I don't know. So here's how I would describe this. In an ideal world, we would go off for a year or 2 and build this agency, and then we'd come back and we'd have some modest little proposals and we'd kind of see how those worked, and then we'd try some a little bit bigger proposals, right? And then in the 3rd year you'd start, we can't do that. And we can't do it for 2 reasons. It goes back to Crystal's question. There's just too much suffering out there. And getting an honest market is part of our healing. And so we have to start acting now. But the second goes to the question you raised. There are those who want to see this agency fail for political reasons. There are those who want to see this agency fail for economic reasons. They have probably found each other and are doing what they can to reinforce each other in this effort. They're shooting live ammunition. They've already, I'm just saying what's in the papers. The There are races within the leadership in the House in which people are running on a platform, evidently, of saying, I'll do what I can. Here's the one that really hurts me, to politicize the agency. So I don't know. I worry about this. We have the right tools right now. This is a very strong agency. It's laid out the right way. It's also an agency, I just mentioned this to the side, since I know we've got some government folks in here. It doesn't use tax dollars, which is a kind of surprising moment. What it does is its money comes from the Fed, and the Fed is not part of the tax system. The Fed raises its money off the sale of treasuries, basically. The Fed had both the power and the responsibility for decades to work in the consumer area. It did not. Let's just be blunt. It did not. So what this agency is set up to do, what Congress did, is they said, okay, Fed, set aside 10% of your income. Do I have any tithing specialists in here? To note the symbolism here. And you shall tithe to the consumer agency, and that will be the budget of the consumer agency. Now, if the consumer agency needs more money, it can ask Congress for more money, but it otherwise doesn't go to Congress. And the importance of this is there's no lobbying group to back this up. Remember the David and Goliath fight I told you about getting it into place? If this agency has to go to Capitol Hill every year to ask Congress for enough money to keep everybody on staff, we know where this goes. The lobbyists descend on the committee and try to strangle it, because if the agency's hands are tied and feet are bound and it is starved, then it won't act. So the issue has certainly been raised. For now, I'm just doing my job. I'm just doing what I can to get this agency set up as quickly as we can and to start on working on the mortgage market and the credit card market and payday loans. Those are kind of the first three things we're working on.
Kevin, in your paper here, I love the title, Make the Print a Little Larger, Please. And the first line is, I'm scared of the financial services industry. And I'm wondering if that's a common feeling around this table. There's a real fear about what's happened. I read things about what's happened to your friends, deep trouble. This is a generational fear, is it not?
I think so. I think it is, especially for those of us who are already engaged in financial products with student loans and with credit cards that we've been told we have to get, that we need, and it's something you do. And I think I, for one, didn't quite analyze whether that was necessary, and here I am. And glad to be here, and it's going all right so far, but I think it is scary because I don't quite understand all of the terms of those agreements, and I hope the print will become larger and simpler, and easier for those of us to understand who aren't in the finance realm. So I think it's prevalent among my peers, but
When I was a student back at the University of Houston, there were a series of muggings. And I don't know if any of you have ever been to campus at Houston, but any of you have ever been to any of the southern campuses, there can be some gorgeous foliage because it's a semi-tropical climate. And what would happen is you'd get all these gorgeous ficus and so on, and dense and grew all the way to the ground. Muggers would just kind of nestle back in them. And you just wait till somebody's even with you, and they'd just be on it. Mostly on young women, and took their purses and sometimes hurt them and that kind of thing. So the campus is just all back and forth and back and forth and back and forth about this, and a lot of people are really worried. And this being Texas, a lot of people start carrying guns. That's a whole separate story. But then one day, somebody at the university had a brilliant idea, cut down the shrubbery. So they just re-landscaped. It is a beautiful campus, but it is not a campus with a lot of shrubs right next to the sidewalks where people walk. That's how I think of the fine print. It's not a question of we have to figure out 48 ways to police it and beat people out of them and see who's in there and see who's hiding. I think of a lot of these as shrubbery. And so, back there between clause 16 and 17, both of which are already unreadable, and you have no time for it, right, is where it's just a great place to nestle in an additional fee or an additional cost, just a little something extra. Has anyone ever had a good surprise out of the fine print? Anyone ever get a call from the bank that says, we're giving you $35 this month because it turns out in the fine print, we buried this thing that's going to, no. So my view on this is we really need to re-landscape consumer credit agreement. If the customer can't see it and read it easily, and I'm talking measured in minutes, 3 minutes, 4 minutes, so that you can make easy comparisons, then the answer is it probably shouldn't be. We have to have that conversation. How can you bind people to terms that you know they aren't reading, and you don't want them to read? So we're going to see if we can re-landscape this. That's at least the hope. But I hear your message, and I completely agree.